In 1929, stocks crashed 89% and took 25 years to recover. In 2008, housing collapsed. Stocks fell 57%, and recovery took 5 years. In 2026, everything crashes together for the first time in history, and the tools that saved us before no longer exist. The Federal Reserve can't cut rates to zero because they're already low. They can't print unlimited money because they just did that and caused the worst inflation in 40 years. The government can't bail anyone out because it's drowning in $36 trillion of debt. So the real question isn't whether the crash is coming. The real question is this. When 3 simultaneous bubbles larger than anything in history collapse at the same moment, and every tool used to stop previous collapses has already been exhausted, what happens to the 58% of American households who now have their entire retirement savings exposed to markets that are about to lose 70% of their value? This is not speculation. This is mathematics. And the math stopped working 2 years ago. To understand why 2026 is different, you need to see what almost nobody is talking about. We are not in one bubble. We are in 3 bubbles that have never occurred together in 300 years of financial history, and they are all peaking at the same time. Start with stocks. The S&P 500 is trading at a price-to-earnings ratio of 28. That is nearly double the historical average of 15 to 17. This level of overvaluation has only occurred twice before. In 1929, right before the Great Depression, and in 2000, right before the dot-com crash that destroyed 78% of the NASDAQ. Both times, the market crashed within months, but 2026 is worse because of concentration. 7 stocks, Apple, Microsoft, Nvidia, Amazon, Google, Meta, and Tesla, represent 30% of the entire S&P 500's market value. That means if these 7 companies crash, they take the entire index with them. This concentration hasn't existed since 1929. When a handful of industrial stocks held up the market right before it collapsed. Nvidia alone shows you how insane this has become. The company trades at a price-to-earnings ratio above 65. That means investors are paying $65 for every single dollar of profit the company generates. Nvidia's market value exceeds $3 trillion, making it worth more than the entire economy of Germany, the 4th largest in the world. This is not valuation. This is speculation driven by artificial intelligence hype that mirrors the internet mania of 1999. Everyone believes AI will change everything, just like they believed the internet would change everything in 1999. They were right about the long-term impact. They were catastrophically wrong about short-term valuations. And we are watching the exact same pattern unfold now. The second bubble is real estate, and it is actually more overvalued than the 2008 housing bubble that destroyed the global financial system. Right now, home prices are approximately 50% above their long-term historical trend relative to income and rent. At the peak of the 2008 bubble, homes were 35% above trend. Let that sink in. The crisis that required trillions in bailouts and nearly collapsed capitalism was a 35% overvaluation. We are now at 50%. And most people don't even realize we're in a bubble because prices have been high for so long it feels normal. That is how every bubble ends. It feels normal right up until the moment it doesn't. But residential real estate is only part of the story. Commercial real estate is in freefall, creating a slow-motion crisis that will accelerate through 2026. Office buildings across America sit 45% vacant as remote work becomes permanent. San Francisco has a 35% vacancy rate. These buildings were financed with mortgages when interest rates were 3%. Now those mortgages are coming due and need to be refinanced at 7% to 9%. The buildings are not worth enough to support the debt at triple the interest rate. This means defaults, bank losses, and a cascade of failures that will mirror 2008, except this time it is commercial properties instead of residential. The third bubble is what makes 2026 unprecedented, the bond market. Government bonds are supposed to be the safe asset you hold when stocks crash. In 1929, bonds were safe even as stocks fell 89%. In 2008, Treasury bonds rallied as investors fled to safety. Government has issued so much debt that the bond market cannot absorb it anymore. Total federal debt exceeds $36 trillion, approximately 125% of GDP. That is the same debt to GDP ratio America had at the end of World War II. Except after the war, America was the only major economy not destroyed. Today, America is competing with countries that have lower debt and stronger fundamentals. The annual interest payment on this debt now exceeds $1.2 trillion per year, making it the single largest line item in the federal budget, larger than defense, larger than Social Security. When your interest payments exceed everything else, you have three choices: cut spending drastically and cause a recession, raise taxes drastically and cause a recession, or print money to pay the debt and cause inflation. All three options lead to crisis. There is no good path forward when your interest payments alone equal the GDP of Mexico. So how did we end up in a system this fragile without anyone noticing? The answer is that crashes do not happen randomly, they follow patterns. And once you see the pattern, you realize we are not stumbling into 2026 blind. We are walking, step by step, down a path that has been walked twice before. In 1929, stock valuations reached extremes never seen before. The price-to-earnings ratio of the Dow Jones hit 33, far above any historical precedent. In 2026, we are at nearly the same level. The public in 1929 believed that new technology, electricity, radio, the automobile, had created a permanent new economy where old valuation rules no longer applied. New era was the phrase repeated constantly. In 2026, artificial intelligence is the new technology that supposedly makes old rules obsolete. The rhetoric is identical. Margin debt in 1929 reached record levels. Everyone from doctors to shoe shine boys was borrowing money to buy stocks. Stories circulated about ordinary people getting rich overnight. In 2026, margin debt as a percentage of GDP is at similar extremes, but modern leverage goes beyond margin accounts. Options trading by retail investors has exploded. People are using credit cards to buy stocks. Companies are borrowing billions to buy back their own shares at inflated prices. The leverage is everywhere, hidden in derivatives and debt structures most people do not understand. Wealth inequality in 1929 reached extremes where the top 1% controlled 25% of total income. This meant the economy depended on a small number of wealthy people continuing to spend. When they stopped, the system collapsed. In 2026, wealth inequality is even worse. The top 1% controls 32% of total wealth. The economy depends on the top 10% who control 70% of consumer spending. If the wealthy stop spending because their portfolios crash, consumer demand disappears and the economy collapses. But here is where 2026 is actually worse than 1929. In 1929, only about 10% of households owned stocks. That means 90% of the population was not directly affected when the market crashed. They suffered later through unemployment and deflation. But the initial crash did not wipe out their savings because their savings were not in the market. In 2026, approximately 58% of American households own stocks either directly or through retirement accounts like 401ks and IRAs. This means when the market crashes, it directly destroys the retirement savings of more than half the country. There is no insulation, no buffer. Everyone suffers immediately. The banking sector in 1929 was fragmented across thousands of small banks with no federal insurance. When the crash came, banks failed because depositors panicked and withdrew their money. In 2026, we have FDIC insurance that supposedly protects deposits up to $250,000. But the FDIC has only about $125 billion in its fund while insuring approximately $10 trillion in deposits. If multiple large banks fail simultaneously, the FDIC fund is laughably insufficient. The government would have to print trillions to make depositors whole, which would destroy the currency through inflation. Either depositors lose their money through bank failures, or they lose it through inflation. Pick your poison. But if the parallels to 1929 show us the pattern, the parallels to 2008 show us how much worse it will be this time. In 2008, the crisis began with subprime mortgages, loans to people who could not afford them, packaged into complex securities and sold worldwide. When housing prices stopped rising, borrowers defaulted. The defaults cascaded through the system, revealing that banks were massively overleveraged and holding worthless securities. In 2026, subprime lending exists everywhere, we just do not call it subprime. Auto loans with 84-month terms at high interest rates to people with poor credit. Credit card debt at record levels with average interest rates exceeding 21%. Student loans totaling $1.77 trillion that will never be fully repaid. Corporate debt that quintupled from $2 trillion in 2008 to over $10 trillion today. The leverage in 2008 was concentrated in housing. In 2026, it is everywhere. In 2008, the Federal Reserve had powerful tools. Interest rates were 5.25%, giving the Fed room to cut all the way to zero. The Fed could also implement quantitative easing, buying trillions in bonds to inject money into the system. The Fed's balance sheet went from $800 billion before the crisis to $4 trillion by 2014. This money printing helped avoid collapse, but it created the bubbles we are dealing with now. In 2026, interest rates are already low, giving the Fed minimal room to cut. If they cut dramatically, they risk reigniting inflation. If they do not cut, they let the economy crash. Quantitative easing is similarly constrained. The Fed's balance sheet is already over $7 trillion after multiple rounds of QE. They can print more, but everyone now understands that printing money causes inflation. The 2021 to 2023 inflation surge, the worst in 40 years, proved that you cannot print unlimited amounts without destroying the currency's purchasing power. The Fed is trapped. The government bailout capacity is also exhausted. In 2008, the government could borrow to bail out banks because federal debt was about 67% of GDP. The Troubled Asset Relief Program authorized $700 billion. This was politically unpopular but economically feasible. In 2026, federal debt is 125% of GDP with trillion-dollar deficits as far as the eye can see. The government does not have another $2 trillion to bail out failing banks. If they try to borrow it, bond markets will revolt, interest rates will spike, and debt service will become even more unsustainable. The bailout option that saved the system in 2008 does not exist in 2026. So if we know the pattern and we know the tools are gone, what does the collapse actually look like when it starts? The crash will not announce itself with a clear starting point. It will begin with something that seems manageable, an earnings miss by a major tech company, a larger than expected regional bank failure, an escalation in a geopolitical conflict that the trigger almost does not matter because the system is so fragile that any shock will start the cascade. When Nvidia or another Magnificent Seven stock misses earnings or provides weak guidance, algorithmic trading systems will start selling instantly. The stock could drop 10% to 15% in a single day. Because Nvidia represents 7% of the S&P 500, that alone takes the index down nearly a full percentage point. But the real damage comes from psychology. If the AI story that has driven valuations starts to crack, investors will question all tech valuations. Microsoft, Apple, Amazon, Google, Meta, Tesla, all would sell off in sympathy. Within days, the Magnificent Seven could be down 20% to 30%, taking the entire market down 6% to 9%. This triggers margin calls. Margin calls are the accelerant that turns a decline into a crash. When investors buy stocks with borrowed money, and those stocks decline, the broker demands additional collateral. If the investor cannot provide cash, the broker sells the stocks to cover the loan. This forced selling drives prices lower, which triggers more margin calls, which forces more selling. In 1929, margin calls created a downward spiral that could not be stopped. In 2026, margin debt as a percentage of market value is similar to 1929 levels. When the selling begins, it will be rapid and relentless. Institutional investors managing trillions in pension funds and endowments have risk management rules that require them to sell when markets decline beyond certain thresholds. These are not emotional decisions. They are automated. When stocks fall 20%, risk systems trigger selling to prevent further losses. Within the first month, stocks could easily be down 30% to 40% as retail panic, margin calls, and institutional risk management all drive prices lower simultaneously. The cascade moves from stocks to bonds as investors flee to what they believe is safety. But in 2026, Treasury bonds are not safe because the government needs to issue trillions more. If there is a flight to safety at the same time, the government needs to sell bonds, interest rates spike even higher. This creates a doom loop. Higher rates make the government's debt service higher, which requires more borrowing, which requires issuing more bonds, which drives rates higher. Countries caught in this loop typically end in either default or currency collapse through inflation. The housing market freezes, buyers disappear, sellers refuse to accept lower prices, homes sit for months without offers. People who need to sell for job relocations or financial reasons start cutting prices. These cuts establish new comps that drive all home values lower. Within 6 months, home prices could be down 20% to 30%. Within a year, 40% to 50% declines are realistic in overvalued markets. Homeowners who bought in the last 3 years find themselves underwater, owing more than their homes are worth. But what happens when the collapse moves beyond markets into the real economy, where people work and live? Commercial real estate defaults accelerate as property owners realize they cannot refinance maturing mortgages. They stop making payments and hand the keys to the lender. The lender, typically a regional bank, takes possession of a property worth 40% to 60% less than the loan amount. This wipes out the bank's capital. When capital ratios fall below regulatory thresholds, regulators close the bank. In 2008, 465 banks failed over 5 years. In the coming crisis, we could see similar or higher numbers in a much shorter period. Bank failures create panic that spreads to banks that are actually solvent. Depositors see banks failing and rush to withdraw money from any bank they perceive as risky. This creates a classic bank run. Even healthy banks do not have enough cash to pay all depositors simultaneously because they have lent the money out. When a run starts, the bank has to sell assets at fire sale prices, creating losses that turn a healthy bank insolvent. The FDIC steps in, but the $125 billion insurance fund is inadequate. The government has to print money to cover deposits, which starts the inflation process that destroys the currency. Employment collapses as companies cut costs through layoffs. Tech companies that grew bloated during the boom lay off 10% to 20% of workforces. Finance companies heavily exposed to market declines cut staff. Consumer companies facing customers who cannot spend close stores. Within 3 months, unemployment could rise from 4% to 7% or 8%. Within 6 months, 10% is realistic. Within a year, 12% to 15% unemployment is likely. And here is where artificial intelligence, the very technology that drove valuations to these extremes, accelerates the collapse instead of preventing it. Estimates suggest up to 300 million jobs worldwide could be lost or degraded by AI by 2027. Displacement is hitting not just repetitive tasks, but specialized cognitive roles. This sharply reduces consumer purchasing power, creating a feedback loop of declining demand and production cuts. The paradox is brutal. During downturns, sustaining employment is essential to avoid collapse. But AI accelerates the replacement of workers precisely when maintaining jobs is most crucial. The AI market is booming, expected to reach nearly $300 billion by 2026 and potentially add $15.7 trillion to global GDP by 2030. But the benefits are unevenly distributed, exacerbating inequality and social unrest. If AI causes widespread unemployment without income redistribution, businesses face a collapse in demand as former workers can no longer purchase goods and services. The economy eats itself. So what does this mean for someone with a mortgage, a job, and a shrinking paycheck? For the average American with a 401k or IRA, watching a retirement account decline 60% to 70% will be devastating in ways that go beyond numbers. Someone who spent 30 years saving and has $600,000 will watch it drop to $200,000 or less. That is not a correction. That is the destruction of a financial future. They cannot retire. They have to work 10 to 15 more years, assuming they can keep their job. For people already retired and depending on withdrawals to fund living expenses, the situation is worse. They are forced to sell assets at the bottom to pay bills, locking in losses they will never recover. In 2008, retirement accounts dropped but recovered within 5.5 years. In the coming crash, recovery will take much longer, if it comes at all. Japan's stock market crashed in 1990 and did not recover to those highs until 2024, 34 years later. An entire generation never recovered their wealth. The same could happen in America. Housing wealth destruction will trap millions in homes they cannot afford to sell. Young people entering the workforce will find no jobs. College graduates in 2026 and 2027 will face brutal competition for the few positions available. Studies of people who graduated into the 2008 recession showed they earned less over their entire careers. The coming crash will be worse, meaning the scarring will be deeper and last longer. Small businesses will be decimated as consumer spending collapses and credit becomes unavailable. The local restaurant, the retail shop, the family-owned service business, these will fail by the hundreds of thousands. Large corporations with access to capital will survive, though smaller. The economy that emerges will be even more dominated by massive corporations, reducing competition, innovation, and dynamism. Social safety nets will be strained beyond capacity as unemployment surges and tax revenues collapse. The government will face increasing demands for services and decreasing ability to fund them. Spending cuts will be necessary even as more people need help. This creates a humanitarian crisis on top of the economic crisis. And then there is the global dimension. In 2008, China was booming and helped pull the global economy out of recession. Europe, while affected, was not in the same debt trap. In 2026, China is experiencing its own crisis with a collapsing real estate sector, local government debt exceeding $13 trillion, and a demographic crisis as the population shrinks. Europe is dealing with energy crises and political fragmentation. There is no major economy in position to lead recovery. When the crisis hits, every country will be fighting for survival, rather than coordinating solutions. The United States and Europe will be hit hardest, followed by export-dependent economies like Japan and China facing fallout from weakened global demand. Recession in early 2026 could turn into something worse: rising unemployment, potential severe financial stress, even soaring interest rates if the dollar's reserve currency status is threatened. The scale of the downturn is amplified not just by cyclical factors, but by technological disruption and structural vulnerabilities. So if this is already baked in, what choices do ordinary people actually have? The most reliable predictor of recessions over the last 70 years has been the inverted yield curve. When short-term interest rates exceed long-term rates, it has predicted every recession since 1950 with no false positives. The yield curve inverted in July 2022, remained inverted for 27 months, and normalized in September 2024. Historical analysis shows recessions typically begin 3 to 12 months after normalization. That puts us in the danger window right now, through September 2025, extending into early 2026. The signal that has never been wrong is telling us the recession is imminent. Warren Buffett, the most successful investor in history, is hoarding cash at levels he has never maintained before. Berkshire Hathaway's cash position exceeds $325 billion, the highest in the company's history. Buffett has been selling stocks, including reducing his massive Apple position. His own metric, the Buffett indicator, sits at 185%. He has set a reading above 120% indicates dangerous overvaluation. At 185%, the signal could not be clearer. The world's best investor is sitting in cash, waiting for the crash. Insider selling has reached levels that historically precede major declines. Jeff Bezos sold over $13 billion worth of Amazon stock. Mark Zuckerberg has been selling billions in Meta. Nvidia executives were selling even as the stock hit new highs. This is what happened in 1929 and 2000. Insiders know when valuations are insane, and they get out before the crash. Consumer debt has reached levels that make 2008 look manageable. Credit card debt exceeds $1.14 trillion, an all-time record. Average balances are $6,800 per household, with interest rates averaging 21% to 28%. Delinquencies have risen to levels not seen since 2011. Consumer spending represents 68% of the economy. When consumers cannot borrow anymore and have to pay down debt instead of spending, the economy contracts. We are at the point where consumers are maxed out. Over $2 trillion in commercial mortgages come due in 2025 and 2026 and must be refinanced. These properties were financed at 3%. Today's rates are 7% to 9%. A building that barely cash flowed at 3% is bankrupt at 8%. When these mortgages cannot be refinanced, owners will default. Regional banks holding these mortgages will realize massive losses that wipe out capital. The FDIC will run through its insurance fund within weeks. The government will have to print money to cover deposits, destroying the currency's value. Unemployment has started rising from 3.4% in early 2023 to 4.1% by late 2025. The SOM rule, which has predicted every recession since 1970, states that when the 3-month moving average of unemployment rises 0.5 percentage points above its low, the economy is in recession. We are at or near that threshold now. The trend is rising, and once it starts, it accelerates. These are not predictions. These are facts. They are happening right now. So could the 2026 crash lead to a complete restructuring of the global financial system? Goldman Sachs warns of a potential 10% to 20% equity drawdown within the next 12 to 24 months, noting that a disorderly unwind could trigger systemic risks and threaten financial stability. Is entering stage 6 of a long-term debt cycle, which historically culminates in revolution, war, and debt restructuring, a financial reset not seen in nearly 100 years. Economist Fred Harrison forecasts a global collapse in 2026 based on an 18-year land cycle, arguing this is the end of a 54-year supercycle that could force fundamental restructuring due to unsustainable land speculation and wealth inequality. National debt exceeding $34 trillion as a key vulnerability. If debt servicing costs rise sharply or confidence in the dollar erodes, this could trigger a currency crisis and force global restructuring. Historical precedents like 2008 and the Great Depression show that major collapses have led to significant regulatory and structural changes, new banking rules, monetary reforms, shifts in global economic leadership. The consensus among leading institutions is that while a severe correction or recession in 2026 is possible, a complete global restructuring would require a systemic collapse, a disorderly debt unwind, currency crisis, or geopolitical shock. That remains a tail risk, not the base case. But tail risks have a way of becoming reality when every other indicator is flashing red. So why is 2026 worse than 1929 and 2008 combined? Because we have the asset bubbles of 1929 in stocks, the debt bubbles of 2008 in housing and credit, and a government debt bubble that did not exist in either crisis. All three are happening simultaneously. In 1929, only stocks crashed, and only 10% of Americans were directly affected. In 2008, housing crashed, but the government could borrow to bail out banks and the Fed could print without causing inflation. In 2026, everything is crashing together and the tools do not work anymore. The Fed cannot cut rates to zero because inflation is still elevated. They cannot print unlimited money because they just did that. The government cannot bail everyone out because it is drowning in debt. The 12 warning signs are not speculation. They are facts. The inverted yield curve, Warren Buffett hoarding cash, regional banks failing, commercial real estate collapsing, consumer debt at records with delinquencies rising, unemployment rising, insider selling at crash levels. Every indicator is flashing red simultaneously. The timeline is clear. The yield curve normalized in September 2024. Recession typically comes 3 to 12 months later, putting us in the window of December 2025 through September 2026. Commercial mortgage refinancing peaks now. Credit card defaults are accelerating. The trigger could come at any moment, and once it starts, the cascade will be unstoppable. When the crash comes, stocks will drop 65% to 80%, worse than 1929 because it will be faster and more concentrated. Bonds will drop 35% to 50%, something that did not happen before. Real estate will drop 40% to 60%, worse than 2008. Unemployment will exceed 15%. And recovery will take not 5 years like 2008, but 10 to 20 years or more because the Fed has no tools left and the government has no borrowing capacity left. This is the everything bubble. Everything crashes together, and there is nowhere to hide. Those market crashes in history books, the ones we thought could never happen again because we learned from the past, are about to repeat with a violence and scale. That will shock everyone who believes it cannot happen. The mathematics of unpayable debt, overvalued assets, and exhausted policy tools guarantee it. The pattern has repeated twice, 1929, 2008. Both times the warning signs were ignored until it was too late. Both times people believed this time is different. Both times they were catastrophically wrong. We are in the same pattern now, only the scale is larger and the tools to stop it are gone. The crash is not a possibility. It is a certainty. The only question is whether you see it coming. If this gave you a new lens on what is actually happening, subscribe. Because the answers are rarely in the headlines. They are buried in the patterns most people refuse to see until it is too late. And by then the damage is already done.